If the Magnificent Seven sneeze in New York, your KLCI portfolio in Kuala Lumpur catches pneumonia. Most Malaysian investors think Bursa Malaysia is insulated from the AI bubble because we have no Nvidia, no Microsoft, no Tesla on our exchange. That belief is exactly what makes 2026 so dangerous. Let me explain why. Roughly 35% of the entire S&P 500 is now concentrated in just 7 AI-linked megacap names. When that bubble corrects, and history says bubbles always correct, the spillover hits emerging markets first and hardest. Foreign funds hold a meaningful slice of KLCI free float through names like Maybank, Public Bank, Tenaga, and CIMB. When global risk-off mode kicks in, those funds do not sell Apple. They sell what they can sell quickly, and that means Malaysian blue chips. Now layer on the ringgit. We are still trading near 4 ringgit 60 to the US dollar. If the Federal Reserve panics and cuts aggressively to save tech valuations, you might think the ringgit strengthens. The opposite often happens, because capital flees to dollar safety during equity stress. A weaker ringgit imported inflation will squeeze Bank Negara into holding rates higher for longer, which crushes domestic consumption stocks. What about palm oil as a hedge? Many Malaysians treat Sime Darby Plantation, IOI, and KLK as defensive plays. Be careful. Crude palm oil prices are tightly correlated with global growth expectations and Chinese demand. An AI-led tech correction usually triggers a global growth scare, and CPO futures historically drop 15 to 25% during those windows. Your supposed hedge becomes a second source of pain. So what should a Malaysian retail investor actually do right now in 2026? 3 things. First, check your concentration. If more than 40% of your portfolio sits in KLCI top 20 names, you are not diversified, you are correlated. Second, build a ringgit cash buffer of at least 6 months of expenses in fixed deposit or money market funds, because liquidity disappears fastest during crashes. Third, consider a small allocation to physical gold or XAU exposure, which historically outperforms when both equities and emerging market currencies weaken together. I am not telling you to panic sell. I am telling you to stress test your portfolio before the market does it for you. If this gave you something to think about, comment below with your current KLCI exposure percentage, and I will personally review the riskiest ones in tomorrow's video.